Welcome back to the Strong Money Podcast. Today, Jacob and I are going to be diving into the cons around contributing Bitcoin to an irrevocable trust structure. If you listen to the last one, we went over, why Bitcoin is essentially the best asset to own in an irrevocable trust structure. So now we want to just talk through the downsides because there are downsides. That's true with really any decision that you're going to be making in your overall financial plan. There's always trade-offs, no matter what decision you're making. And so, a lot of our job is education when we're working with clients. It's educating them on, pros of a decision, cons of a decision, and the lifestyle considerations, the considerations related to their goals. What we're trying to do is give them a foundation to stand on to be able to make their own informed decision. Of course, we make a recommendation at the end of the day, but we don't want people just to rely on our recommendation. We want them to be able to think through it on their own, be equipped with the knowledge to make decisions. And so that's the approach we're also taking with this podcast. We're going to talk about the pros, cons of everything that, we're going through, including Bitcoin. So this one is going to be, like I said, about the downsides and why you may want to avoid putting Bitcoin into an irrevocable trust structure. Just to summarize what we spoke about last time, I mean, the primary reason that we're looking to utilize these structures is to, one, mainly tax savings, in general. It may be a big year with a business sale and we have a large amount of income coming in, and so we want to offset that tax bill, or we're looking to avoid the estate taxes, which, if you listen to the last one, can easily get up to 40% very quickly, above the current federal exemption limits. And so, that's the primary reason behind, wanting to utilize one of these structures. And you can go listen to it to, get more detail around why we believe Bitcoin's the best asset to hold in there. But again, there is the other side of things. So we're going to be going through that today. Excited to dive in?
Heck yeah.
Cool. So let me start with maybe the smaller reasons why we wouldn't want to hold Bitcoin in an irrevocable trust structure. Really, if we would want to avoid this if we want to utilize the assets now, or we're going to be wanting to benefit from the assets in the near future, maybe in our retirement, wherever you are in life. We don't want to lock up, or basically lock up. It would be a good phrase to use, the assets in a irrevocable trust if we want to benefit from them in the near future or maybe in the present. So the first two reasons why we would want to avoid this is if we want to, donate now. We want to just go ahead and make a donation to charity, or we want to spend the money, over time, making memories with our family or achieving, XYZ goals that we may have, in the near term, maybe in the long term. So, really starting with the low hanging fruit, I would say, if you still want to, benefit and have control of and use these assets within your lifetime, then, you may not want to put them into an irrevocable trust.
Yeah. And you say a small point, but it honestly is probably one of the biggest points because I think it's, you kind of prove this out. It's theoretically, it's very easy to say, oh yeah, I can't use these assets for whatever reason, in the near future or long-term future, but during my lifetime, that's fine, whatever. But when it's 10, 20 years down the road and you're like, man, I really wish I had those assets to use, that's a pretty big deal. Like that can really, suck in a lot of ways. So, yes, I get what you're saying, and it is certainly a smaller consideration in some ways. But I do think by starting with it as the primary consideration is good too for that exact reason, because it truly is. That whole premise of if we put assets into an irrevocable structure, we can no longer control or benefit from them. That has a lot of implications for how we live our lives, or could have a lot of implications on how we live our life. And so, I know some people that are listening to this that are a little more sophisticated might say, well, there's ways around some of that when you're still within an irrevocable trust structure. And there is, and maybe we'll talk about those at some point in the future. But again, this is, we're talking in general here, the status quo, the main way these things are used. So yeah, it really is something that should be, considered fully, right? And that's, um, again, I mean, part of that too, when we think about, well, will I need this? This is where Bitcoin makes things difficult, because traditionally, if we're just putting in real estate or stocks or whatever other kind of normie asset, um, we've got a lot of history to kind of prove, okay, yeah, if we put stocks into an irrevocable trust, they're going to grow at 8% a year, whatever it is. So it's very easy to say, okay, well, okay, I want to put this amount into the trust and I want to keep this amount out of the trust, because that amount in the trust is going to grow to X and the amount I keep outside of it is going to grow to Y, right? So it kind of makes it a little easier to have, at least, it's not true confidence, but at least some sort of confidence in that you're putting enough in, and on the other side, you're keeping enough out, again, to kind of fund some of those, whether it's charitable or just your lifestyle goals. With Bitcoin, it gets much more difficult because, for one, we only have 14 years of performance history. For two, the first 6 of that, you can kind of just discard. Really, when we're basically looking, I would say 2015, 2016 forward, as far as what we're referencing for some sort of assumed future growth rate. But even that, we just don't know, right? Bitcoin is, as far as its future performance, sure, people will say, well, it's going to infinity, it doesn't matter. Okay, sure. But let's live in the real world and be like, okay, what if it does anything less than infinity? What happens in that circumstance? And then that is where it gets difficult, because you can err on both sides of the equation. Um, because if you assume that Bitcoin's going to have a higher growth rate than what actually happens, maybe based on that assumption, you put more into an irrevocable structure than what you should have. And now Bitcoin doesn't grow as much. The Bitcoin you kept out of the irrevocable structure, it doesn't grow as much. And again, this is where it's saying, you're 10, 20 years down the road and you're like, man, I thought it was going to compound at X, but it actually compounded at X minus 5. That's a substantial difference. And now you're kind of a rock in a hard place. And then vice versa. If I assumed X and then it actually performed X plus 5, maybe that meant that you could have put more into the irrevocable structure than what you otherwise would have. Because I think we've kind of talked in totalities a lot with this topic so far, and that it's like, okay, yep, we're going to max out the lifetime exemption. Most people aren't going to do that. Most people probably aren't going to max out the lifetime exemption. They're just going to utilize it in some regard, while maybe not fully maxing that lifetime exemption out. And so that's where the flip side can then come, is like, man, I wish I would have put more in, because I actually have more than what I need now, and I still might be subject to more state taxes than what I would like to be. And so, yeah, I'm not saying there's a clear, definitive answer on what the right amount should be, but it is why, again, maybe it's a smaller consideration, but it is the primary consideration. We have to understand what we think we're going to need first, so that we can at least use that as an educated base to build off of for, okay, so what can we do everything else, or what can we do other things with?
Yeah, no, absolutely. That's a great point. And I think, the longer you have until maybe your expected death, which is, we don't know what it's going to be, but if we're in our 30s, we would expect we have a much longer lifetime, ahead of us than somebody in their 60s or 70s already. And so we kind of have to, prepare for that wide range of possibilities. The longer that period is, the wider the range is of possibilities that could happen. And so, I think it's also important just to mention, you can update, things along the way with your estate plan. Like if you, take advantage of some of the, portion of the exemption now, you get 15, 20 years down the road and it's like, okay, Bitcoin grew way faster than I expected. Maybe I put a little bit more now into another irrevocable trust. You can stack them in that way and continue to iterate, on the plan. This is why ongoing financial planning is so valuable, because things can change very quickly. There's a lot of variables that we need to think of, for one, but then those variables could be different tomorrow, like literally that quickly. And so, that's the benefit in having an ongoing, relationship with, a financial planner like us, because we can evaluate when things maybe do need to be changed, or at least discussed again, brought back up. Like, hey, Bitcoin has done X. When we initially came up with this plan, we expected Bitcoin to do Y, so we need to revisit this basically, and think about this. And that, maybe it's not Bitcoin's the variable, maybe it's the legal changes. Maybe the estate tax exemption gets lowered or raised, or, whatever it may be. And so we have to start to rethink the entire plan, altogether. I think we could both confidently say, I would never put all of our Bitcoin into an irrevocable trust structure.
Well, yeah,
Is that fair?
yeah. No reason in the world why you'd do that. I mean, you don't want to put any asset in an irrevocable trust structure.
Well,
Like,
yeah, but I'm not saying all of your assets. I'm saying, okay, what if
oh,
somebody is 50-50? They
hmm,
50-50 net worth as far as Bitcoin versus other things.
hmm,
Um, because we don't know what the future is going to hold. So if we put all of our Bitcoin into an irrevocable trust and we hold on to the more traditional investments, Bitcoin does what we think it can do. All of a sudden, those traditional investments are repriced in
hmm,
Bitcoin, and now we need to benefit from we need the Bitcoin back, basically, because everything else is back to its maybe utility value, or if it's stocks, maybe the multiples are just cut, very significantly, because now they're being, again, repriced on a Bitcoin standard. So I would think you would agree with that as well.
yeah, for sure, for sure. Yeah, it's.
Not everyone has 100% Bitcoin. I mean, you know, this is
Wait, you're telling me not everybody makes the same decisions I do? That's just blowing my mind right now. I thought everybody thought the same way. Because how could you think different?
totally, totally. I'm right. Everyone else is wrong.
Yep.
Yeah. I mean, you know, honestly, what we're seeing though right now, just with prospects coming in, is there's a fair amount that are 100% Bitcoin.
Yep.
I mean, it's kind of 50-50, I would say, if I had to, just roughly put a number to it. And so it's interesting to think about for sure. But yeah, for someone who doesn't own, maybe it's only 15% of their net worth, but they have a decent sized net worth. That's why they're even considering this in the first place. We would probably still not want to put all the Bitcoin into irrevocable trust structure. We would probably put a different asset in, even
Mhm.
though, yeah, we talked about previously that Bitcoin is, the best asset to hold. And you can go watch that video to see all the reasons why. If that's the case, though, and it's a smaller percentage of your overall net worth, but it's still significant, we still wouldn't want to put it all into this structure.
For sure.
Cool. All right, let's go ahead. Anything else on kind of, I guess one thing we didn't mention, the reason why I said donate it now is because a lot of these irrevocable trust structures that you can achieve charitable goals, along the way, even with money put in there, or you can achieve your charitable goals, once you do finally pass away, just depending on the type of structure that you use. But if you're like, hey, I just want to donate this now, because that's just a decision you want to make. You're not worried about the tax considerations, nothing like that. You just want to be generous, then fair enough. Can't argue with that.
Yeah.
And then were
Uh,
you gonna add something there?
yeah. I mean, I think it's because I don't think we may have said this last time. I can't remember, but one of the cool things, and I mean, we should probably just do now that I think about a whole episode on gifting, but um,
Yeah.
one of the cool things about our tax law, which there's not many, but this is one, is that you can actually give a set amount to specific individuals. Normally we see this as family, but it could be other individuals too, and not have it lower your lifetime exemption limit at all. And so you can do that per person, both the giver and the receiver. So I think this year it's like 17,000, maybe 17,500 per person. So to just give a quick example, if you're a husband and wife and you have 3 kids, you could give $34,000 to each child every year and have it not lower your lifetime exemption limit at all. And that's, no taxes on their side are due. They get a step up in basis because it's a pure gift that they're receiving. And so it is, when we talk about giving it away now, that's one reason why we might want to at least consider that alongside the irrevocable trust. Because if the point of the irrevocable trust is to get assets to the next generation while not having it included in your estate, that's another thing that we would want to make sure we can take advantage of. Because right there, that's what 34 times 3, so 100 and just over $100,000 basically that you can give to your children, no tax consequences, not lowering your lifetime exemption limit, and them getting a step up in basis along the way. So that's a pretty neat thing to be able to do if you can do it.
Yeah, good point. And it's actually $18,000
Oh, is it?
currently. So a little bit more, 36 in total per person, or I guess 18 per recipient. And then if you're a married couple, like you said, 36. And a fun thing to think about too, I would that I mentioned to you, I think is, I don't know, a couple months ago, is gifting upwards as well. If we're going to be maybe taking care of parents, or there's even the chance that we could be financially responsible for them, and we've been blessed with the ability to do that, to take care of them. That's a privilege at the end of the day. Gifting upwards is a different strategy. Maybe they don't need to spend it or spend it all, and then they can continue to hold the Bitcoin until they pass away, and then you receive it back with a step up in basis at that point. So that's an interesting consideration as well, because like you're saying, if we got if we're giving to each of our kids 36,000 each, all of a sudden now we have 36,000 each to each parent. So we have mom, dad on both sides. There's another 4 people that we could give money to, and that starts to get into a very sizable amount that you're giving away on an annual basis without any tax implications on it. So yeah, it's definitely
And to keep on this
interesting.
rabbit hole for just a second, because I've already decided this is, whether it's our next episode or not, like this is where we need to go, just because I've got like all these ideas that are coming up. But what I think one thing for the Bitcoiner that is so should be considered in light of all this a lot is, every Bitcoiner knows the frustration of seeing Bitcoin for what it is in full, eyes wide open, clear as day, and then having a conversation with another person, normally the family or close friends, and them just completely nope, like not even want to consider it, not even the first point. And like, hey, I'm really trying to do, help you, make a good decision for yourself. This isn't selfish. Like I'm trying to help you see what I see, and they just won't do it. And so this whole gifting thing and this whole gifting idea, no matter what capacity it takes, it really is something that, I mean, I've talked with Heather about it before. It's like this Bitcoin we're accumulating, it's not just for us. Like this is our family, our group, our close knit communities pot. And I really do believe that. And I think that Bitcoiners would be better off if they start to view it that way, because again, Bitcoin is a ground up type movement. And so the only way that we're really gonna, help Bitcoin become what it can is to make sure that it stays that way. And we can do that by being, hey, we're not just accumulating this for us. It's for our family, for our mom and dad, for aunts and uncles, for cousins, whatever. And I'm not saying that means, oh, we're just giving all our Bitcoin away to everybody. But I do think that mindset needs to be part of our thinking, because, again, to use the cliche we continue to say, if Bitcoin does what we think it can do over a long enough time horizon, especially if you're younger, I mean, we're talking about really significant amount of wealth, just to be plain and simple. And I think one of the things that Bitcoin can do is kind of drives this mindset of, okay, well, it's great that I can benefit from it. That's fine. And like, yeah, I want my my individual family, Heather and my kids, to benefit from that. But what if I can, broaden that benefit? What if I can do that for more people, and those people that I really do care about? And I think that needs to be something that's considered. So we can climb back up out of the rabbit hole and save that for another discussion.
Yeah. No, I love it. That's definitely a good point to make. And, it kind of blends the whole, yeah, we have the tax, considerations and avoiding, different taxes, but we're blending it with, goals that we want to achieve. That I am a generous person. I want to take care of the people that I love. Like, that's a good match there. We can easily say, yeah, well, here's a good strategy to utilize to achieve two birds, one stone kind of thing. So it's a good point to mention for sure. One that we didn't talk about as much is spending it, while still alive. I mean, we kind of did, but I one thing I just want to say with this is, we always hear about never selling your Bitcoin, never spending your Bitcoin. Totally get it. We're on the same page, but also don't feel guilty. Don't feel guilty if you want to actually utilize the wealth that you've been able to accumulate and worked hard to store up, over time to, go make some memories with your family, go on a, vacation, whatever it's going to be, whatever ideas that you have, dreams that you have, it's okay to let that wealth actually allow you to achieve those. And you don't need to feel guilty about it. Of course you want to make sure you're not doing that at the expense of taking care of your family over the long term, sacrificing maybe a retirement or something like that. But, if you have the wealth to be able to do it, you don't have to feel guilty about going out and actually doing that.
Yeah. Yeah, to reiterate what we've said many times before, Bitcoin is the means, not the end. Don't let it become the end. If it's the end, it just becomes your idol. And especially for those who hold similar values to us and our faith, then that's just a no go on multiple fronts. So let Bitcoin be the means. Utilize the means necessary for your situation and what you want to, and this whole like, oh man, I wish I would have spent Bitcoin because it could have been worth X or whatever. Who cares? You got to experience life. I mean, again, to your point, as long as we're not doing that to the detriment of other goals that we have, then why does it matter? Why just so you could say you have more? Not a great outcome.
Yeah. I mean, if we're thinking about kids, obviously that's on both of our minds right now. It's like they're only going to be a kid once. You're only going to be able to go on that trip when they're 10, one time. And if you don't take advantage of it, who cares if Bitcoin 10x'd, after that? Like you traded your Bitcoin for a once in a lifetime opportunity. That's what, gaining a memory or experience with your family is. You only get it one opportunity to do it at that specific point. So I love that. Maybe I should have started with this one. It's a little bit, I would say, lesser of a consideration, but it's still an important one. Before we dive into the custody and the big ones that Bitcoiners need to hear about, we're going to save that one for later, so everybody has to continue listening, or maybe they're going to fast forward right now. Who knows? That's the biggest one for sure. But as far for Bitcoiners specifically. But no step up in basis. So this one is something that was changed. You mentioned it last time, but I had it on the docket already for this agenda, so it's cool that you mentioned it. This was changed, I think 2020, 2021, maybe. I don't remember exactly when it was. But if you hold assets outside of an irrevocable trust structure, you pass away, it goes to your child. Their new cost basis is the value of the Bitcoin on your date of death. So whatever the market value was, if Bitcoin was at 100K, you pass away, the Bitcoin goes to your son. Your son's new basis in that Bitcoin is $100,000. So obviously that's a big, tax advantage, basically, receiving that step up in basis for the next generation. If they receive the assets through one of these irrevocable trust structures, they do not get that step up in basis. So it still is the cost basis, the original cost basis of the assets. And so, whenever they go to maybe sell or do something with the funds, they're going to owe a bit more in taxes than they would have otherwise. So it's still a consideration. I think the estate tax consideration trumps the capital gains tax consideration, just because they're much lower and you can, work your way around the capital gains taxes throughout your life. But it's still something to think about.
Yeah, for sure. And just to flesh that example out more, basically what we're saying is if you bought Bitcoin at 20K and gets to 100,000 and you die when it's at 100,000, if that Bitcoin goes to your beneficiaries outside of an irrevocable trust, their basis is not 20,000, it's 100,000. So they've basically got to miss $80,000 in capital gains they otherwise would have had to have incurred if they would go to sell the Bitcoin, which again, hopefully you've educated them enough to say, hey, maybe don't at least sell all of it right away. But irregardless of that, so that outside of the irrevocable trust, that's the benefit. All right, we missed out on that 80K. Inside of the irrevocable trust, they're going to receive that initial $20,000 basis. So if they, same example, 20,000, now it's at 100,000. They now, if they go to sell, they're going to have to realize $80,000 in long-term capital gains. Which thankfully those tax rates are a little more preferable than income tax rates, but it's still paying taxes nonetheless. And so, this is the point I think I talked about last time, that normally when we think about putting assets into an irrevocable trust, we want to put the most highly appreciated assets into them. So, okay, if we have one Bitcoin that has a basis of 20 and then another one that has a basis of 80, we'll put the one with 20 in there, because then that leaves us the one with 80, which leaves us with a lower tax cost, basically, to the Bitcoin that we're holding, because we're likely going to use it in some capacity in our life. But when this whole consideration, if you're like, hey, I don't really care about the tax consequences for me, I would rather this benefit my heirs, my beneficiaries to the maximum, then you might flip that scenario on its head. You might say, well, I'll keep the really low basis stuff and gift the high tax basis, because that's only going to help them out more down the road. So it's certainly, there's not a right answer, but it is something to be aware of, because I think they did that specifically just because they were trying to neuter the use of these irrevocable trusts a little bit, because that's what people do. It's just like, just put in, a ton of it, because they get this step up in basis, and that's, really, really beneficial for multiple reasons.
Yeah. Yeah, absolutely. And maybe that'll get changed again. Who knows? I guess we'll see. But yeah, it's just something to think about. Um, and even if they did receive it, this is probably in 20 plus years, maybe not. But even if they did receive it at a low cost basis, they can allow it to continue to compound and grow over time and borrow against it, to avoid the tax implications, to avoid the capital gains taxes. So, essentially the longer you can let it ride, the better, as we all know. Um, awesome. So let's discuss then at a more general, before we get into the specific custody, considerations and in that stuff. Let's just talk about on a more general basis. You are severing, control and benefit from these assets when you go to put them into an irrevocable trust. So obviously, we've kind of touched on it, but I just wanted to speak to it directly. That is the definition of irrevocable. Once you put the funds in there, it's very hard or nearly impossible to change. And so, you may have certain beneficiaries that you want to change, or maybe the stipulations on the trust aren't what you actually wanted in 10, 20 years, whatever. Or we've already kind of spoke to, you won't be able to spend it or benefit from it. But yeah, I just wanted to specifically touch that piece before we dive into what the custody implications of that are.
Yeah, to give a specific example that I've seen before,
Cool.
there's something known as an ILIT, an irrevocable life insurance trust. So people use these trusts a lot when they have large estates that are going to incur estate taxes. They'll put in life insurance policy, a whole life insurance policy, inside of an irrevocable trust, so it doesn't contribute to the increase in your estate value, but it can go to pay the estate taxes on it. So it's another alternative strategy to just directly putting assets in an irrevocable trust, as you can get this life insurance, which again, that's a whole nother episode talking about how Bitcoin really does change that game in some sense, if we can do a Bitcoin whole life policy, or a whole life policy denominated in Bitcoin. Anyways, so with an ILIT, again, You have this life insurance policy. It goes into the trust. It's irrevocable, so you no longer can really do anything with it. But let's say you have three kids and you set this up and you say, "Hey, yep, I want this to benefit my three kids to go to pay their portion of the estate taxes." Well, let's say that because you still have control of your estate, one of your children you want to remove from that estate. You don't want them to receive anything for whatever reason, which is, those are normally not uh, great scenarios in the first place, but and I've seen it happen. So you want to remove them. Well, now all of a sudden you've got an irrevocable life insurance trust that still has them as a beneficiary. So you can remove them from being a beneficiary of the irrevocable life insurance trust, but what does that require? That requires them to approve of their removal as the beneficiary of the irrevocable life insurance trust. And I don't know too many people that would necessarily willingly do that. That's where you get into some fun legal battles, so to say, if you try to do it otherwise. So, I mean, but that is a real consideration with this. Is like, okay, you put assets into there, you no longer want people to benefit from those assets. Well, sorry, buddy. Like, that's there, right? That decision has been made already. Of course, you could always put in stipulations that it's up to trustees' discretion and all this and that. But at the end of the day, you still are not the trustee. You still cannot direct necessarily the trustee what to do. And so it is like, okay, assets are there. They're going to whoever you say they're going to when you establish that trust. So yeah, it's certainly something to consider, because yeah, if we're setting these up and you still have got likely a long time left to live and probably a lot of life changes that are going to happen in between now and your eventual death, then okay, maybe that's a good reason to maybe look at alternative structures, at least in the interim, from strictly just especially I should say, like doing a fully funded irrevocable life insurance trust. The islet structure could certainly be one of those, but
Yeah. Yeah. I saw a tweet actually of a guy. He was talking about, he was asking, I don't know, he was crowdsourcing advice, I think, but he was sharing a scenario where he said that his father was divorced, now has a new wife, um, and has really no estate plan in place outside of the assets going to the wife, the current wife. And he said that his dad was decently wealthy. That's relative to everybody, so who knows what the actual numbers are. But um, he was describing the situation, and he said that he talked to his dad, and his dad said, "Yeah, everything's going to go to my wife." And then there's that scenario where okay, everything goes to the wife. Now, when the wife passes away, though, she may decide for it to avoid his children. And so obviously we can get, into many, many different scenarios of what could happen in the future. We don't really know. But, that's another scenario where it's like, well, a trust structure could work to maintain control basically beyond the grave, if you will, to avoid, your wealth. Yeah, you definitely want it to go to your wife, your current wife. If you're married, I mean, I don't know who wouldn't want that to happen. But you know, if there's the potential scenario that then the assets could completely avoid your kids that you had from a previous, marriage, then it's definitely something to think about. So it's just another divorce is another consideration, with setting these things up to where you could run into some sticky situations that you don't want to. Obviously, with our faith and where we're approaching things, we're not, I don't know how to exactly word my.
you're not planning on
Uh,
getting divorced.
yeah. I mean, you're not planning on it,
Be a grave sin if you
so
did.
so, but it's something that still happens, in the world, and so it's a consideration to bring up. Um, so, all right, anything else to add there, just on a more general perspective of, once you're setting this thing up and you fund this, it's you're not going to be able to change it, basically. Um, Anything else you want to add?
No, I think we covered it.
Cool. All right, so we have mentioned now the custody implications a couple times, and some people were probably thinking about this. Okay, if I am putting assets into an irrevocable trust that I no longer have control over, I can no longer benefit from, how's the Bitcoin going to be held? And this is where we can run into a lot of issues, with Bitcoiners, depending on their perspective of things. Obviously, we encourage everyone to self custody, and we help, facilitate that. But then when we start to think about these trust structures, if you can no longer control the assets and benefit directly from them, then you have to give up possession of the private keys. In general, we'll say, there, again, we can probably go into specific, trust structures in future episodes to where maybe that's not the case. But again, speaking generally, just in this conversation, you will have to give up custody. And so there's a lot of considerations there.
Yeah. Yeah, and I mean, we save this one to the end. And we don't I don't think we do like the timestamps on our YouTube. So people will if they're going to skip ahead, they're going to just have to pick and play until I can find this. Um, uh, but yeah, I mean, to me, this is probably not the biggest consideration. I think the biggest consideration is just, how much to put in here. But, um,
Yeah.
the secondary biggest consideration, I suppose. Um, because yeah, as you said, like you no longer can have custody of these assets. Full stop, plain and simple. You couldn't even. So let's use an example that some people like to say, and yeah, this is where it's like we could caveat on caveat on caveat, but for in general, if you want to say, well, I'll run a multi-sig, I'll hold a key, and I'll have two third parties hold a key, a trustee, and then whatever, a trust company of some sort. So I never can control the Bitcoin because you need to move the Bitcoin. So it's fine in that sense. And then I can still, still have a key or whatever. Well, in that scenario, which we've talked about before on the flip side, if somehow your trustee or the trust company loses their key, which I mean, hopefully they don't, but if they would, now you're in a good old Mexican standoff with whoever that other party is. So yes, you can't necessarily uh, move the Bitcoin by yourself, but you can certainly stop the Bitcoin from being moved. And so when we talk about, not having control, benefit, ownership of those assets, that certainly to me sounds like an indirect control mechanism that could get you into some dicey circumstances. So this is where it's like, yeah, you probably can't hold anything. And so when, we've talked about this in our self custody episode, I would say you really have one of two extremes then. On one side, you have a kind of more pure custodial play that you're just going to go to the Coinbase Trust or maybe a River Trust or something like that. Basically, go to an exchange, have the trust account open there, and then that's where the Bitcoin is held. On the other extreme, you might go to a multi-institution, multi-sig type setup where you hold no keys on that side either. If we're doing an irrevocable trust, it likely makes more sense to go to that secondary one, the latter one. But at the end of the day, it's still the same premise. You don't have control of the keys. Even if you could do this, you could do a single sig setup. You could do a single sig and just say, okay, trustee, here's the key. Whole crap ton of risks with that. I'm just saying, all right, trustee, yep, Bitcoin's 100x from where I gave it to you. Don't do anything bad. Don't be a bad person. Like hopefully they're not. Ideally, but we live in a broken and fallen world, so things happen. So you could go the single sig route, but it really is that's where it really gets to one of these two extremes. And yeah, I mean that just provides risks, right? I mean you got. Even though I see it as very unlikely, you've got like the 6102 type risk, where, that's the whole gold was confiscated back in the day type thing. Like, okay, well, if your Bitcoin is owned by even in a multi-institution, multi-sig, the government comes to all three of those institutions and say, hey, yeah, use your private keys because we're taking this. Like, I would venture to guess most of them are going to do that. This is where you get into some more complex topics of multi-jurisdiction, multi-institutional, multi-sig. So maybe some of your institutions that you're utilizing are not domesticated in the US and you have them in other countries. That can provide some of the what they would call jurisdictional arbitrage on this sort of thing. But by and large, that's a at least right now. Hopefully, in the future, when a key agent kind of if we do like a key, what are we going to call it? Basically, if it's very easy to go and find a key agent to do whatever you want, you have a marketplace, key agent marketplace. That's the word I'm looking for. That might make this sort of thing easier because then you can just go and choose 3 different jurisdictions to hold your 3 different keys, and then off you go. 3 different trust companies across the world holding your keys. But to climb back up out of this, really what this gets to is you can't really, not really, you can't at all hold custody of the keys yourself. So you've got to go to one of these other options that provides risk, whether it's the 6102 or just trusting those companies in general. And that's got to be one of the bigger considerations because it's like, all right, cool. Like you put your Bitcoin in there, but if you can't control it, what do we always say? Not your keys, not your coin. Like it still is true, even when it's in one of these trust structures. So, it's not necessarily a reason not to do them, certainly, right? But it is a reason to maybe just take a pause and be like, yeah, I'm just going to get everything out of my estate and send it downstream. Okay, well, let's think about that and, think about that for a second. So what that, lends to or probably leads to over time, not over time, but for some people, is more of this, okay, I'm going to accept that I'm going to have an estate tax liability, and now I just have to figure out how I'm going to fund that or help my beneficiaries or heirs fund that. And what I'm saying there is if you cannot accept that someone else is going to control and have ownership over that Bitcoin, then you really have got to say, okay, well, maybe do some of that gifting stuff we talked about earlier, right? Give every person that you want to gift any money to that $7,000 or $18,000 per year per person, so you can get some of it out of your estate beforehand. But outside of that, then it really just comes down to, all right, I'm going to have a tax liability. How do I, want to help people fund this? And I know this is the cons episode, but that is one of the reasons why Bitcoin, one of the awesome things about Bitcoin as a estate asset in general is it's not land where your beneficiaries, have to wait for years before they can really sell it to pay their estate tax liabilities. They can do it overnight on on an exchange if they really wanted to. So, big consideration, that one.
For sure. Yeah, and most people listening are probably thinking, okay, well, why can't I just make it like my brother or maybe my best friend or something like that? You mentioned the risk with it being a single sig setup and having a single trustee. Now they are in charge of the Bitcoin. But if we were even thinking about your brother or even someone who's related or close to you, it can't. The trustee of the trust cannot be a related or subordinate party to you. So it can't be somebody who's like works for you in your business. It's one of your employees or something like that, or whatever. If it's someone who is again related or subordinate, is what the the code says, then it's going to be very hard to prove that you do not have some level of control over the decisions being made, within the trust assets. And so you're then having to go to somebody outside of your social circle or your close knit family to be the trustee. And so I don't think anybody is going to trust any one single person outside of, maybe an immediate family member to hold the keys to their Bitcoin, especially when we're talking about large amounts. I mean, the whole premise of, I would say the primary premise of putting the funds and the assets into an irrevocable trust is because we're looking to avoid the estate tax. And as of right now, the exemption limits are pretty high. So that means that our overall net worth is pretty high as well. So, the amount that we're putting into this is no small pennies, especially if Bitcoin, grows like we expect. And so, just wanted to clarify there that, it can't be, okay, my son holds the keys now. Like that's not going to work. And so that's where you are really forced to, like you said, maybe have a multi-sig setup where there are multiple co-trustees and none of them can act, unilaterally. You're maybe not holding a key, but, three outside parties are, and none of them could act, unilaterally. Effectively, what you're doing there is setting up your multi-sig, multi-institutional, except it's not an institution, it's a person, which, there's trade-offs for sure. So yeah, it's definitely a big one. Like we said, we can get into more specifics around maybe certain types of trust where maybe could get around this in some ways. But you're still kind of operating in a little bit of a gray area, with where we stand right now, just because, the legal system has not caught up to Bitcoin. We know that for sure. And so, we have to go off of legacy, laws and previous precedent that has been put in place. And so, whether or not you want to kind of flirt with that is up to you and a decision that you can make personally. But at the end of the day, it's just important, again, to understand the complete picture when you're making these decisions, which is, again, why, it's very helpful to work with, in an ongoing relationship with people like us. Like, I know we're just shamelessly plugging our service, but at the end of the day, we truly believe in its value and believe there's return on that investment you'll make by working with us, or we wouldn't do this as a business. We wouldn't offer this as a service. And so, if you go to an estate planning attorney and you talk through this stuff with them, good luck if they're going to know anything about the custody aspects, for one. But also, they're probably going to lean towards you setting up a trust, because what does that mean? They get to draft the documents and charge you, bill you on the hour for all the work that they're doing. The more complex, the better in their mind. And so, from our view, that's a biased perspective. Whereas for us, we don't benefit, in either direction. Really, you are truly our top priority, making sure you're completely educated on everything you need to be thinking about and the trade-offs of each decision you're making. And we probably have good relationship with you enough to where we know your relationship with your family. We know the dynamics going on. And that's a whole nother consideration with this stuff, because like we mentioned earlier, when you set up and fund an irrevocable trust, it can't be changed. And so, understanding family dynamics can be important also in making these decisions. That someone that you just go to and talk to on an hourly basis may not fully understand and be able to grasp like we would, being involved in your financial picture for, hopefully a long-term relationship. So just things to think about. The last point that I wanted to make, but you touched on it really, is, okay, so now if we're utilizing this trust structure and we're using a custodian to hold the Bitcoin, we are further at risk for a 6102 type attack. Of course, we're trusting a third party. We're bringing in a counterparty risk, of course, that, self-custody allows us to get away from if we want to. So we're reintroducing that counterparty risk, but now we're also, because they're going to be regulated and, have reporting requirements and all of that stuff, they're going to be most likely, like you said, to comply, with the government if the government wanted to attack. And they're going to be the first place that the government goes to. I mean, they're going to go after large banking institutions that maybe can custody Bitcoin. They're going to go after the, exchanges that are holding a significant amount of Bitcoin before they're going to go after anything else. So something to think about. Like you said as well, I agree with you that that's unlikely at this point. Could that change? Who knows? Maybe it's kind of, we as Bitcoiners feel a lot better with Trump in charge. But, still, are we willing to take that risk, even though we think Trump's not going to do anything nefarious, and then who knows what's going to come after that? We may set up a trust and move it to a custodian under Trump, but the next administration is, completely anti Bitcoin, and we swing back the other way, and all of a sudden now this is a big risk back on the table that we're concerned about. So, we could go on for a long time talking through all the considerations, details, what ifs into the future. And that's ultimately what we do with our clients. It's impossible really to get into in a podcast structure. But yeah, I think that covers it pretty well. Anything else you think would be good to mention?
I think the last part, which I would expect at some point in the future we'll talk about, is just there are creative strategies that kind of blend the world of revocable and irrevocable trust, in the sense that it's irrevocable and it's out of your estate, but also by way of some, quite legitimately loopholes,
Mm-hmm.
you can still benefit from it. So this is where, Mitch, you were saying just a minute ago, like, hey, these things are there, and they're not even so much a part of the, it's like legacy, but they're not cut up to Bitcoin. I mean, no, you can do these same loopholes with legacy assets too. But the fact remains that these loopholes will probably be closed at some point in the future, which probably just means that there's other loopholes that will open up. This is one of the more, I think, eye-opening things about once you really start to look at these more complex estate planning considerations, is realizing just how much ease and availability there is to get tax benefits, but then also avoid the kind of downside of some of these structures that we've been talking about today,
Yeah.
and specifically in losing that benefit. So, we're aware, for everybody who's been screaming it this whole time, but again, maybe a different conversation for a different day. I don't know. Maybe we'll see where we go, but yeah, I think that's probably the last piece. Last piece for me.
Yeah. No, I mean, we'll definitely get into specific, structures and how, we can maybe get around some things. Um, it's definitely important to mention. And I'd be surprised if anyone listening is screaming out. There's very few people that are listening to Bitcoin related podcasts that also understand this stuff. Maybe you do get the estate planning attorney or something, the token attorney that's listening that knows this stuff, or maybe you get the token financial planner that's listening to us. I don't know. Maybe they are, maybe not. But yeah, I mean, there's just infinite what ifs. There's, as you're saying, a ton of loopholes that could be utilized when it makes sense. You don't want to jump into complexity or anything unnecessarily. You want to make sure that you're not allowing, maybe lower priority considerations to drive your decisions when it comes to your financial plan. At the end of the day, you want to make sure that the wealth that you've accumulated is allowing you to achieve the goals in life that you want. And if something is going to be causing you more stress than anything else, maybe it's not worth the tax savings. So, yeah, I guess maybe just one point to hammer home. We've already said it, but just to reiterate is, yeah, there's trade-offs, but let's zoom out a little bit and just remember that, you're trying to avoid 7, 8 figures in taxes. And that's not a hyperbole. Like, if you're utilizing this, you're looking to avoid a very, very large amount of taxes. And so, it's still a consideration of, okay, do I want to give up custody to save $10 million in taxes? Well, I mean, only you can answer that. But let's just keep that in mind. Let's not look at just the downsides and be like, oh, I'm never going to give up custody. It's like, okay, I get that, and if that's your choice, great. But there's going to be somebody who says, I'm willing to give up custody so that $10 million more worth of Bitcoin can go to my grandkids. Like, that's, and whether or not that actually happens and the risks come true with the having custody Bitcoin, who knows? But at the end of the day, make your own decision and understand why you're making it. Make it from an intentional place with a clear perspective on the entire picture, is what we're trying to get to. So, cool. Well, I appreciate you listening all the way through. Again, if you want to listen to the pros of holding Bitcoin in an irrevocable trust structure, go listen to our previous episode. Or, if you're interested in any other Bitcoin related financial planning topics, you can look at our other videos here, or go check out our website, strongwealth.net. We've got a blog up there with some blog posts about some of these topics we believe Bitcoiners should be considering when it comes to their financial plans. So we'll continue to pump out as many videos as we can, because I don't believe many people are producing content on this stuff. So we want to get it out there to everybody to provide that value, and if it makes sense, work together, of course. But yeah, I just wanted to shout that out, just in case this was intriguing and you'd like to learn more. But all right, we'll go ahead and see you in the next video. Maybe we'll go ahead and dive into some of these specific trust structures. I don't know. We'll see. We'll get to it in the future for sure, but I'm not sure where we're going to go next.